Welcome everyone back to the channel. Today I'm very excited about this discussion by Sebastian Hayworth. We're going to be talking all about Palantir, about the mechanics of the company, the financials. Sebastian is an investment banker, so this is going to be very technical, but we're going to make it super understandable, hopefully, for all of you to follow along, asking the hard questions when it comes to Palantir and its future of the stock and everything else. I want to welcome you today, Sebastian. Thanks for joining.
Thanks, Jackson. It's a pleasure to be able to be on.
Yes, thank you so much. And you said you have a disclosure. I will make the disclosure. None of this is financial advice, and obviously do your own research. And obviously, none of this is going to play out exactly how we are forecasting, predicting, and analyzing, because there's always a divergence like that. But would you please just add on your disclosure as well?
Yeah, happy to. So just anything I say today is just my own personal opinion, not reflective of any of the opinions of my company. And all the financials or projections that I have are just solely my own projections and nothing related to my own company, like the company that I work for, projection.
Excellent. Okay, so today I thought it would be great to talk about Palantir, sort of beginning how we even, what the best way even is to forecast and analyze growth companies. We'll get into a discussion on the price to sales for Palantir, some long-term guidance, what they've said so far, valuing Palantir with the equity method rather than a full-on DCF. And also, we're going to talk about the discount rate, which you would assign that to for Palantir once we get to a long-term equity value down the road. And we'll be using 2030 as that year. And then also a little bit of talk on dilution, PEG ratios, which are pretty fun. And yeah, just risk reward of Palantir to other names, and maybe touch on some other topics as well. So let's get started. I want to ask you right off the top here, Sebastian, what do you think is the best way to value growth stocks in the market, perhaps independent of how the market is evaluating or giving either exuberance or is really down on growth stocks? What do you think is a good intrinsic way to get to the bottom of what you should be paying for any growth stock, really?
Yeah, I mean, you brought up a great point about just the equity method. But I think one of the biggest things that's missed in terms of just valuing growth stocks is actually basing their valuation on how fast they're growing or how fast they're expected to grow. Because a lot of people have this misconception that all of a sudden, because you're paying over 100 times earnings or 30 times sales, that it's automatically an expensive company and maybe overvalued. That's common logic in a lot of bears with Tesla, for example. Like they think that there's a huge overvaluation at play simply because of the multiples that are being put on the company. But if you step back and you say, okay, and look at how fast the business is actually growing, then you can say, is the multiple warranted or not? And there's a way to determine that, and we'll have to touch on this later too. But you can look at like a PEG ratio, which is like the price to earnings ratio, but compared to the growth of the business. Because if, let's say, a business is expected to grow at 100% year over year, then you should be completely fine with paying at least 100 times earnings, for example, in that business, simply because that would equate to like a PEG ratio of just 1, and that's a fair value. Peter Lynch basically created this concept of PEG, which is great for valuing these like high growth businesses, specifically, like doesn't even have to be like a SaaS business. It could just be any business that's in like hyper growth mode, which is it's going to be useful at valuing these businesses. And like I guess traditional fund managers, when they look at just like valuing just value stocks, they'll use more of the traditional multiples. Like they'll look at the industry multiples and say, okay, what is the like the comps trade at here? What is the like historic multiple that this business has? Like one of my favorite investments that I made personally was in Simon Property Group. Like I don't think many people are very familiar with Simon Property Group, but it's one of the largest mall owners in all the U.S. It is the largest mall owner in the U.S. and they're a value stock. And the way you look at like their values, you say, okay, like there's a real estate investment trust, and they trade on like instead of like price to earnings, they trade on like price to free cash flow. Instead of like looking at just the growth of the business, you'll say, okay, maybe let's look at more of the historical trading multiple for this company, which is like around 13, 15 times free cash flow. And so that's the multiple that you put on the business. If that's how you value a value stock. But if you're looking at a growth stock, you say, no, we're not going to look at like the historic multiple we're going to put on this business based on where it used to trade. No, we have to look at like how fast is this company growing and then assign a multiple based on that growth rate.
Yeah. Thank you for that explanation. It just brings to light the dangers of growth stocks as well, in terms of when that growth either starts to slow or entirely stops. And I think that should be very evident to everyone, because I think that's very important. But as you said, like that growth, like there is core intrinsic value in that growth, especially over a multi-year time horizon, in terms of what that actually does to the numbers and compounding on top of those financials.
What you had said, it's hard to that switch when it becomes like a value to like a growth to a value play. Like that's happening with Netflix right now. So Netflix is transitioning like its valuation criteria from how fund managers look at it. Instead of valuing it based on like the like typical growth, you're valuing it now as like a value stock. And there's that valuation reset, which is like very hard to kind of like go back from one way to the other. I think that's obviously why like Bill Ackman had exited as like one of the key reasons. And then just the last thing on that point would just be that, you know, sometimes for these high growth names, it's hard because sometimes they have really hard comps, which you're starting to see like when you compare to 2020 and 2021, and the growth rate is based on those higher comps. So that's why sometimes it looks like the multiples coming down, even though maybe the stock is like completely cratered, but the multiples come down because of the fact that you're having extremely high comps that you have to compare yourself against. So, you know, eventually that'll kind of like that bumpy road will normalize itself. But yeah, just points to bring up.
Yeah, absolutely. So on Palantir, I think one of the most popular ways of just looking at it, seeing how it's valued, is the price to sales, which is, of course, the market cap divided by the revenue. And what's interesting is Palantir, such that it's given its outstanding share count and its market cap, it actually seems to trade. The stock price is pretty similar to what the price to sales ratio ends up being, which is fairly interesting. But now we've got Palantir at about 15 times sales, I think, the last time I looked. Could you talk about what price to sales really means, and what that number means to you for Palantir, how you would value it? I think what I've started to learn is you start comparing the price to sales to different companies. And obviously, it's difficult to do that, given different companies are at different growth stages of their business and they're dealing with different businesses entirely. So sometimes it's tough to find accurate comparisons. But then you could perhaps look at an industry average or something like that. What is valuable about the price to sales ratio? And also one thing, I said P/S on Twitter once, and everyone thought I was talking about the price per share. So
what you were saying is like 100% true in terms of like you want to look at like the price of sales relative to, again, like the companies that are like similar but also have like similar growth rates. If you guys don't follow this, it's called Clouded Judgment by Jam and Ball. It's great for looking at just like multiples of businesses and where they trade, like versus where they historically trade. But if you look at like this chart in particular, and I'll zoom in to find Palantir, but Palantir is like somewhere here in like this 30% growth range. Like I'm having a little bit of trouble finding it, but I know it's on this chart. But essentially, like what you want to see is like obviously these multiples have come down a lot since this was last published in March. And so like there's been like a little bit more of like that valuation like compression in terms of a multiple basis. But the interesting thing there is Palantir right here. So Palantir obviously trading at a pretty aggressive like price to sales, but when you compare it to like its relative growth and like the growth of similar companies that, you know, are maybe in the tech space or even like other high growers, they're paying some similar multiples to Palantir. Palantir has been a little bit more exaggerated where the multiples come down because obviously you see like it's even below this line, the trend line. It's below the trend line. So because of like maybe a little bit more of just like actual idiosyncratic business features or like risks that people have assessed with Palantir or like the market has assessed, their multiples been a little bit compressed below trend line. But obviously you want to take all these multiples with a grain of salt because these are not like typical normalized multiples. They're just been so compressed given like the valuation compression that, you know, we've seen. The one thing that you want to identify in price to sales, you want to say, okay, what is like you have to ask yourself, what is a normalized price to sales for Palantir? Now, the way I kind of look at it, and we'll obviously get into this when we talk about like the equity method of valuing it. But the way I look at it is I say, okay, let's look out to 2030 and let's look at similar mature tech businesses and say, okay, what are their long-term growth rates now? And what multiples does the market assign to them on both like an earnings basis as well as a sales basis? So like I would say, like I look at like big tech. So maybe this still includes obviously Meta, but more like the Microsoft, Google, Apple, Amazon. Like that's kind of where I would say is a benchmark for just typical big tech, or Nvidia you can throw in there as well. And then you look at where does like the long-term growth rate for some of these big tech players, and then say, okay, what multiple does the market assign? Looking at margin profiles, looking at growth rates, what multiple does the market assign to these businesses in their mature state? Obviously, taking it with a grain of salt again that their valuations have come down slightly. Some of the mega caps haven't been as hit, but obviously, like Google's been significantly had a good drawdown. So again, these multiples are a little bit more compressed. So there's more of like this normalized multiple that you have to take into account. But in like totality, that's kind of how I look at just choosing what price to sales is right, or like what price to earnings is right for Palantir by looking at where I think it'll be in 2030, assuming that's like a mature state, and then looking where other mature big tech trades at relative to their margin profiles and their growth rates.
Yeah, that's super helpful. So when you say sort of long-term growth rates, are you referring to like perpetuity growth rates or how they're currently growing? Uh, like
Usually
currently,
I
like
look at
what?
like 3 to 5 years out. So like you can look at and say, okay, what is the expected 3 to 5 year? Like you can choose 3 year growth rate, 5 year growth rate, but what is the expected year over year compounded rate of growth for that 3 or 5 years? Not into perpetuity, but just 3 to 5 years out. The PE ratio is based on like you look at like the forward multiple, or you can even like some people look at forward, some people look at like historical, but then you look at the multiple and then you compare it to like the 3 to 5 years, 3 to 5 years out. Just very simple calculation. You can just look at like next year's multiple, like a forward multiple versus like the forward expected growth rate. That can kind of get you to a ballpark. But the best way to do it is really looking at like a forward multiple versus like a forward 3 to 5 year growth.
Okay, very interesting. I think what's tough with Palantir is obviously we don't have so much historicals. They're growing fast. The financials are developing, not yet profitable. So we haven't seen like what are the earnings really going to look like. With Palantir, you had brought this up in their Investor Day presentation. They showed off some long-term targets in terms of operating margin at greater than 35%. This is something we can use to get a sense of, well, we could base a multiple off of that and get a sense of what the financials are going to look like at that point in time. And we said, we're not really sure what long-term means in this case. They're being deliberately vague. Maybe if we just sort of make an assumption, I think it would probably be end of the decade is probably what they're targeting here. I think when they say long-term, it's probably not 30, 40 years, you'd say, right?
No, yeah. I mean, I really do think like my optimistic case is that they're really targeting like a 2025 for this growth rate. And the reason I kind of get there is because like their long-term growth rate, like you mentioned, that they forecasted was in excess of 35% for adjusted operating margin. And just to caveat there, adjusted just means adjusted for stock-based comp. So it's your operating income, but you back out your stock-based compensation expense. And then that margin, that number divided by your revenue is your adjusted operating margin. And so every quarter since they've been a public company, like they usually guide for 22, 23% adjusted operating margin. They're almost always above that. They kind of sandbag that, but that's good to be conservative. The interesting point there is that this last quarter, Q4 2021, they guided for 27% adjusted operating margin. So historically, if they're guiding for 22 to 23% adjusted operating margin, now all of a sudden this quarter they're guiding for 27% adjusted operating margin. It seems like the trend will be to hit that 35% target in 2030. And Palantir's business model is really broken up into three phases, right? Like AES, acquire, expand, scale, right? The acquire phase is negative contribution margin. This is the revenue less your variable costs. Then the expand phase is when you get break even slash slightly positive contribution margin. And then the scale phase is when you have increasing like 80+% contribution margin. And this is where a lot of the margin profile, like the positive margin, comes through in the scale phase. So the way that I look at it is they say, okay, as Palantir expands as a business, and as most of its like year-over-year revenue growth comes from like net dollar retention of like over 100, it's like historically 150%, which is incredibly high. So once it's like it has a set client base and a lot of its revenue is being driven from those continual like clients, right? These clients are already now like in that scale phase, and then some incremental revenue comes from like new clients. But at that point, they're going to have such a big client base that their incremental new clients are going to be like a smaller and smaller percentage, like eventually each year. So that way, there's going to be less like clients in the acquire phase, which are like the lower margin phase, and more clients in the scale phase, which will mean that they're guiding for higher and higher operating margin. And right now they're kind of like in a lull period too, because they're ramping up their sales staff massively. I forget the actual numbers, but they're ramping up their sales staff, which is going to put a headwind on near-term margin simply because you have more salespeople you have to pay, but they're not fully ramped up yet. So they're not bringing more and more sales to the top line immediately. But eventually, you're going to ramp them up. They're going to really catapult, like my view is, they're going to really catapult revenue growth. But now you have the same number of sales staff. The salespeople are a fixed cost now. So, but then once your revenue exceeds your fixed cost, because you're using the same sales staff to generate more and more sales, the more margin you're going to get, which is eventually, I think, what's going to play out, hopefully in 2025. And they're going to have to set new long-term guidance for margin in 2030, which hopefully is in excess of 40%.
Yeah, that's great. That the operating leverage that you're highlighting there is that was an excellent way of putting it, and I definitely think that is going to be the case. I think that we'll continue to hire, but as you're saying, like a lot of that turns into fixed costs in terms of the efficiency likely of the sales team. Could you maybe explain? You were talking about the contribution margin. This is something Palantir loves to highlight, and they use it for a lot of their earnings releases, and they used it at their investor day. Could you maybe explain just in basic terms what this is, what this highlights, and also perhaps how other companies use it as well?
At a high level, it's just simply your revenue less your variable costs, right? And the two components of that, revenue, pretty easy to understand. Variable costs are typically like your cost of goods sold. A lot of like variable costs are baked into cost of goods sold. So this is like the cost to deliver your product. And that's why they highlight it so much, because in the acquire phase, you're delivering the product, right? You're getting it set up for that specific client. Like this is why Palantir has all these different like Foundry for crypto, Foundry for the auto industry, right? So they're tailored to each individual industry. So there is some setup time. Palantir is obviously like their value proposition is that there's minimal setup time relative to how long it would take you to build an internal solution. But there is still that somewhat of that setup cost, that trial cost that they have to account for. And those are all variable costs, because no matter what, each time you sell more and more, you're going to still have those variable costs. They're not going to go away, because you have to, like, that percentage is not going to change. Because like, let's say, okay, you're delivering a software, like a product for $100, right? Each time you deliver that product, it's going to cost you, let's say, like arbitrarily $10 to set it up, for like all setup costs, like that would go into your variable costs. And so each time you sell a $100 product, you're always going to have that $10 charge in variable costs. It's not going to go away. But where you demonstrate operating leverage is based on fixed costs. So and those are usually like baked into like your selling, general, administrative costs. So like you have like an income statement, you have your revenue, your cost of goods sold. These are variable costs. Then you have your gross profit, which is revenue minus cost of goods sold. And then you have all of your like selling, general, administrative expenses. Like this is your R&D. This is your general administrative. This is like your sales and marketing. These are like core, like, SaaS buckets for like costs. And these are usually like fixed costs, like employee wages. You have the same number of employees, you're going to pay them the same wages. Maybe like there's a little bit of a step up, but that doesn't change with the amount of revenue that you have generated from those employees. If each of those employees in 1 year makes one sale, and the next year it makes 2 sales, maybe there's a little bit of commission that's variable, but their base salary is fixed. You're paying that same employee 100, 200K, but now they're generating 2, 3, 4, 5 sales each year. But the revenue minus variable costs getting to contribution margin, Palantir likes to highlight that because this is like the core cost of just delivering the product.
Thank you for that explanation. So then in terms of how we bring this all together, which is, there are a couple of ways to do it, as you said before we started recording, which is you could model out all like the three statements and then actually get down to the cash flows and get those for each year, sum them up, and then discount them back to present value. But you were saying you actually think that it's easier and perhaps just overall a better way of looking at it to use the equity method. Do you think the equity method is just more accurate, or for the reason that doing a DCF, there's so many different like certain calculations that have a large effect on the overall output, or do you just prefer the equity method for the reason that it's more simple, there's less assumptions, and perhaps it's just a better and quicker way of looking at things?
Right. Yeah. I think you nailed all those points. For me, really the biggest driver is that DCFs are so assumption driven that it's easy to make one simple miscalculation that can throw the whole DCF out of whack. Versus in the equity method, there's a few numbers that you really have to plug in. But once those numbers, like there's less in the equity method, right? For Palantir, like I would say, okay, now you have to figure out, okay, what's revenue going to be in 2030? Now, one assumption you need to make is what revenue growth rate is. You have to do the same thing in a DCF. What is operating margin going to be? We have a long-term guidance from Palantir that's supposed to be in excess of 35%. Again, my hope is that 35% is a target for 2025 rather than 2030. But let's be conservative and say 2030. Then you have to assume, okay, whatever the tax rate is, pretty simple. You can assume maybe 21%, the corporate tax rate, 20% to make it simple math if you want. And then you have to say, okay, like what is the interest they're going to pay? Palantir makes it super easy for you because they don't have any debt, which is great. So really, once you get down to operating income, you just take a tax rate on that and you get your earnings. And then the only other things you need to assume is say, okay, what multiple of sales are we going to put on this business? And what multiple of earnings are we going to put on this business? And boom, then you get a price target for 2030. And then you have to then discount that back to the present value, similar to what you would do in a DCF, in order to get the price target for today. And then that present value highly fluctuates based on interest rates. The reason why it's just the market right now, I know it's kind of like tangential, but the reason why the market right now has had such like a massive drawdown, particularly like high growth tech, is because of the fact that their valuations are so reliant on interest rates. And a lot of their value they're called long duration names. A lot of their value comes from so far out in the future because they're supposed to grow so fast. Like Palantir, if it's at $1.5 billion in 2021 and it's expected to get to like 25 billion in 2030, so much of the value you're assessing for Palantir is way out in the future. So it's way more sensitive to interest rates. That's why value stocks, their value is like each year, what do they grow on? Coca-Cola, 5%, 3%, 6% if you're lucky, like maybe like mid-teens if you're lucky, right? But with these companies, they're not as dependent on interest rates simply because a lot of their value is not far out into the future. You can see their value just 1 to 2 years because the business is going to look very similar to what it looks like today in 1 to 2 years. Versus Palantir, at least our vision of Palantir is that it's going to look way different in 2030. But because of the fact that so much of the value we assign to the stock today comes from what we think it will look like in 2030 or 2025, when it's a totally different beast, then therefore more of the valuation is going to fluctuate on interest rates, since that's like one of the primary, like that's how you discount it. You discount it based on like a weighted average cost of capital, which is a function of interest rates. Well, it incorporates interest rates in the calculation.
Yeah. So what's interesting is, because I wanted to ask this as well, is I look at the discount rate. There are a couple ways a couple different names to call it, but I look at the discount rate a couple ways, which is either you can look at it for the reason of discounting to get the present value, or you could look at it as like, this is the annual return I want to receive as an investor, right? Mm-hmm. So let's say I want 15% versus maybe 10% seems to be the average. Now it does depend, as you're saying, depending on the cost of equity and the cost of debt that you need to assume for it. So that will fluctuate by company, by industry, by growth rate. But what I'm saying is, aren't there two ways of looking at it in terms of what someone wants as a return, and then you would discount it based on that to also see the fair value? Or do you really think that's not a good way of getting an internal rate of return, or whatever it
No,
may
that's a
be?
great way. I mean, like you can have a return threshold of 20%,
Yeah.
which is common, not common, but like, some investors out there, they're obviously seeking a lot of alpha, which maybe their return threshold is in 20% range or plus. Um, so the thing with that though is like you would then use like more of your own growth rate for what you want to see like on an IRR basis per year. But I mean, regardless of which way you look at it, the discount rate, it doesn't change the fact that the multiple you assign will get compressed because multiples themselves are also a function of of interest rates. And so your discount rate can change. So it's like I get this question a lot, like all the time, like Palantir has no debt. Why would like if we're not using your own assumed or targeted rate of return per year, and we're more of assuming like the actual calculated way of like weighted average cost of capital, cost of equity plus cost of debt times your interest rate. If Palantir has no debt, then why are they affected? Well, it's also a function of the multiple changes because when the multiple changes, then what happens is because remember, like I'm telling you, like big tech is kind of like the benchmark, right? But big tech is not immune to some multiple compression. And so the logic here is that even if the company has no debt, the reason why its valuation will get hammered in a market environment like this, if it's like a high growth name, is because a lot of like, is because the multiples will also compress based on interest rates. And remember, the value is like that you're ascribing to the company is based on a multiple, and then you discount that like price target, so you get earnings, then you put a multiple on that earnings, which is where you get like so if you have like PE, right? You have a multiple of that earnings, you get the price for 2030, and then you would discount it. But even if your discount rate, however you're looking at it, one of the two ways, that multiple will also change. And that's where a lot of the compression can happen. One,
Yeah.
interest rates, and two, the multiple compression, which also is a function of interest rate.
That's very interesting. Thank you for bringing that up in terms of like the no debt, because I've heard that as well. Just as like a question in terms of, as you're saying, why Palantir would be as affected as it is. But you're basically saying it's like more of like a broad sort of systematic, like across the board, all multiples are affected by the interest rates, and it's not just company specific based on the percentage of debt or whatever, right?
I guess the way to look at it is really like multiples, like just called PE. Like let's use PE, which is very, very common. PE and price to earnings and price to sales are like two of the most common multiples that you see. Like you also see like EV to EBITDA a lot, but just for like Palantir's sake, we'll just use price to sales and price to earnings. The earnings multiple, that's really a function of a few things. One, most importantly, the growth rate. Two, the margin profile of the business. So if it has a higher margin profile, then more of the incremental revenue will flow down to the bottom line, which will affect the multiple you'll put on the business. If you bring in more revenue, more of that's going to come down to like earnings, which then you can grow your earnings a little bit faster, the faster you can grow your top line. If you have a really high margin. The third thing is like return on invested capital. Like the very simple calculation here is like net income divided by your total invested capital, which is a combination of your debt and your equity. And then the last thing is interest rates. So really those four factors are what impact like the multiple. Like anyway, a lot of like analysis you'll sometimes see is like there's not a perfect way to figure out okay what multiple should you put on a business based on whatever the interest rate is at the time. But one of the cool things that I like looking at is like saying okay like the 10-year treasury yield is the most common barometer for interest rates. And so whatever usually like that yield is, whether it's right now 3% or in the past like in excess of 10%, or 5%, whatever it is. One cool thing I like to look at is to say, okay, like what is the interest rate today? And look at like a chart of what the interest rate was historically, going back maybe like 40, 50 years, and say, okay, when it was X interest rate, X percent rate, what was the multiple on the S&P? And then you can say, okay, you'll see there's a very, very strong correlation. There was like at some point, like in the 2000s, where like that correlation broke. And I think maybe that's just because it's you entered into such like an ultra low rate environment, investors want to like they want to put like a theoretical lid on how much they'll put on like a multiple on the S&P. Let's say like the 10 years at 2%. The earnings yield on the S&P, which is just the inverse of the price to earnings, usually correlates very strongly with the 10-year. So for example, like if the 10-year rate was 5%, then historically you could say at that time we could put a 20 times multiple on the S&P and be fair value. And the way you get there is you say, okay, what's the earnings yield on a 20 times multiple? It's simply the inverse, which is 1 over 20. That's 5%. You compare it to the barometer of 10-year rates. That's 5%. And you have this one-to-one relationship. What I'm saying is somewhere in the early 2000s, that relationship broke. Because now, if you're in a rate environment where the 10 year is at 2%, today's at 3%, you're at a 10-year environment where the rate is at 2%, then theoretically, if you apply the same logic, then therefore you could get fair value of the S&P at 50 times, because 1 over 50 is a 2% yield. But what I'm saying is I think there's just like some theoretical cap that maybe it's 25 times, somewhere in that neighborhood, where investors will say, that's it. That's the max we're willing to pay on the S&P before things get overheated and obviously we go into like bubble territory. Otherwise, like if we stayed on that same trajectory, you could see absurd multiples on the S&P and basically get no return other than just simple, 5-6% or like 4 or 5% per year, like EPS growth in the S&P. So sometimes the S&P obviously EPS growth goes faster than that, sometimes goes slower than that. But like that's kind of like how I just like when I try to contextualize how interest rates affect valuation, that's kind of the way I try to look at it. I mean, there's more complex formulas out there. I don't know whoever follows Gary Black on Twitter, but Gary Black is great at kind of explaining like the actual formulaic relationship between interest rates and multiples. I don't get it that in detail, but if you're interested in getting that in detail, he has some great resources and talks about that.
Certainly. Yeah, that's very interesting. I've never dug deep enough to realize that the earnings yield used to be correlated based on the interest rates. That's very interesting. I guess it makes sense as well. And I'm looking at a chart right now, a graph that I'll probably put in after we're done here that says trailing. It's using the trailing S&P multiple price to earnings ratio, and then comparing it to the 10-year. So that's basically what you were just saying. So I'm going to save that for later. And I wanted to move on to talking about dilution, which is a big deal for Palantir. Many people are worried about. It's keeping a lot of investors, I'm sure, out of the stock at this point. What do you think about Palantir's current rate of dilution, where they're planning to go? They're planning to normalize it, and they're working towards that probably in the fairly near term. We got some more guidance from Carp on the year-end call in terms of looking probably 12 to 18 months out and normalizing that. So what are you thinking, Sebastian, in terms of the dilution of Palantir?
Yeah, it's obviously like something that is of key consideration because simply like as you have more shares, then number one, it's hard to keep the stock, like it's hard to increase the stock price since you have more float out there. So you need there's simply more shares to go around, right? So there's more of like, yeah, one hand it creates a little bit more liquidity, right? But it's just like such a big pool of shareholders like that have they're so dispersed out that it's harder to like have the stock price go up. That doesn't say like it's like a limiting factor or anything, but with that, like the key here is saying, okay, you have to say, all right, what's EPS, right? Like EPS is earnings per share is affected by how much your share count goes up. Because as you have a higher share count, the way you calculate EPS is earnings, and then you divide it by the number of shares. So if the denominator, the share count, is increasing, then your earnings per share is going to decrease. So then you put like a multiple on a smaller earnings per share, the more shares that you have. So it's obviously a big problem if it continues like in an egregious way. One, I think that what you said, like the guidance from Carp on the call was pretty comforting in terms of like how he sees dilution and really thinks it's a non-factor like going forward. And secondly, in the future, whether that's 2025, whether that's 2030, Palantir can somewhat counteract this by then instituting a buyback program where they can then trim the number of outstanding shares that they have, which will then help to artificially boost your EPS, which is something that they'll, I think, eventually consider. Not right now, because you're in like kind of hyper growth phase, but in the future, if they have right now they have like 2 billion fully diluted shares outstanding. Now, whether that's 2.5 billion in 2020 and 2030 or 2.3 billion makes a pretty big difference. So I think in the future, there will eventually institute a buyback program, which will then lower the share count and then boost EPS, and minimize this dilution risk that they have today. It's a problem today, but hopefully in the
Yeah.
future,
Yeah.
it won't be.
So I guess the risk there is Palantir never actually gets to institute the buyback. That's some far off sort of long-term positive view on it, right? And if you have a cynical view on Palantir, it's just they're diluting away into oblivion, and maybe that buyback program never comes to sort of get things back in line. So I guess that is sort of the battle between the bull bear argument, where the bears would say the dilution is out of control. Like, we need to wait until we see it actually normalize. It seems like that could be having an effect in terms of how the market perceives Palantir. The nature that they initially set the company up as, which is we're going to give as much ownership away, which I think it may have started posing problems when they tried to go public, but it's just how they run the business. So I think
Yeah.
it's very intentional. And it's not like this is uncommon, more than the average probably, but they're getting it back in line. So any final thoughts on the topic?
I think one thing about just general buybacks is it's very rare that you'll see a buyback at this stage of a company's life cycle. People always say, oh, Palantir is a 20-plus-year-old company, right? They're like an old stalwart that's, they're not like a super hyper growth company, which is completely false from the case. Really, like, if you really look at it, Palantir, one, for Gotham, got like the legislation approved for the army then to have to use Gotham solution, like a private solution, rather than their own, which was huge. And I forget exactly when that came, but it was in the like within the last decade. And then really, you didn't even have Foundry before 2015, 2016. So this product is really only like 6 years old. And Palantir, what used to be valued, I think it was 20 billion, 20 billion in 2015, before they had Foundry. And so I think the market just really struggles to figure out what's like in the private market, what they're worth 20 billion in the private market. I think the public market really struggles to figure out what the value of Palantir really should be. And maybe it's part of the dilution front. But on the buyback case, like going back to what I was saying, you don't really see that at this stage of a company's life cycle. You more see it when it's a little bit more in the mature phase, still growing in the mid-teens, maybe to like slight 20s, like low 20s. But in the phase that Palantir is in, growing 30 to 40% year over year, maybe hoping that will accelerate in the future, not instituting a buyback program. Unless if you have so much free cash flow and a massive cash balance that's what makes sense to do with your cash, because you just can't figure out other ways to spend it. But you won't really see that at this stage. Like one exception to this is like Upstart. I know that's pretty popular stock, something that I follow a lot. Upstart has instituted a $400 million buyback program for their shares, which Upstart is growing over 100% year over year. You might think to yourself, why in the world are they instituting a $400 million buyback program? That doesn't make any sense. I mean, it's usually a red flag. If a company is doing that at this stage, it's usually a massive red flag. But my thought is, well, maybe it's because management and their CEO, David, their CEO basically realizes the market is valuing Upstart on a forward multiple of 17 times earnings. That's like what banks trade at or insurance companies trade at. Banks usually trade like 10 times. They're more of like based on like price to book. But Upstart is an AI platform. that's growing in excess of 100%. You should not trade at 17 times forward earnings. In no way does that, in any multiple environment, even when multiples have compressed massively, in no way does that ever make sense. And so I think their buyback is so that way they can buy up shares when they're just ridiculously cheap and hopefully spur back, this business, not this business, the stock price growth. I don't know if that's the actual reason, pure speculation, but that's just some logic I have.
Yeah, yeah, and that was something I was thinking about. The reason I added buybacks here to the cards, as I was telling you earlier, is like, what happens if Palantir drops to $5 and management really thinks it's undervalued at that point? Is there anything they can do to take advantage of that? And I think that's what buybacks really are for. But we're not at that point. I think I think it is a fairly risky idea when to put the company's cash into the stock and buy it back. I think Palantir has a certain margin of safety with their large cash balance, and I think that's something that investors find as a form of safety. So I think that's good. So one more thing here on Palantir, and then we can sort of wrap this up on the Palantir section, is how do you assess perhaps the risk to reward for PLTR against maybe other growth names, and how do you evaluate it in the space? Is it using these equity multiples that we're talking about? And what would you say to this question?
Yeah, I think it's a great question. So I like to say, like, my barometer for when I try to make an investment is like I look for a 10x. So I don't really make that many investments. Also, caveat, given my current nature of my role, I can't buy shares of public companies right now. Like, I've owned Palantir a lot from before, like when it first was going public, and like in the DPO process, and before I started my current role. But the thing about that is, I say, okay, I believe that there's in a base case a chance to 10x. In an upside case, when they're growing more, way more in excess of 30%, 35, 40, 45%, there's a realistic chance for this business to have like exponential, like their stock price that like just massive growth in excess of 10x. There's always that possibility. And then I look at the downside case and I say, what's the downside case here? And this is where it's kind of doing simple heuristics, like using like an equity method, is very helpful. And I say, okay, well, what if, I just pull out my calculator real quick. Like, what if all of a sudden Palantir doesn't grow at 30% and it only grows at 20%, which is, I think, an absolute worst case scenario for Palantir, only growing at 20%. Could happen. But in 2021, they had top line of 1.5 billion. I think it's like 1.54, 1.53, somewhere right there. But 1.5 billion, just for simple numbers. Now let's apply a 20% annual growth rate through 2030. Okay. So 1.5, I'm just going to do math, 22, 3, 4, 5, 6, 7, 8, 9. Okay. So they're at like 8 billion in revenue in 2030, assuming a 20% growth rate. If you assume a 30% growth rate, they're in excess of 16 billion. All of a sudden, you'll say, take that 7-8 billion of expected growth in 2030 and apply a 35% adjusted operating margin there, which is 35% of that gets you to like 3 billion. And then you say, okay, all of a sudden, now we have to get down to our earnings, which then you apply just simple math, 20% tax rate. So you keep 80% of that down to the bottom line. Now you're at like 2.2 billion in earnings, like just net income. And then you divide that by like, let's just say that their earnings per share, let's say their share count is like 2.5 billion. Today it's at 2 billion. So let's say you go down to 2.5. They're about $1 of earnings per share in 2030 in the worst case, in the absolute worst case. And then you say, okay, a company growing at 20%, typical big tech trades at a peg of like 1.5. So then you say, okay, maybe we can apply a 30 times earnings on this. Palantir then goes and grows to 30 times, which from here is almost a 3x, right? That's not great, right? But if you compare to the returns on the S&P, which you're expected to get like a 2.5x in 10 years time, you're basically just slightly beating the market, right? I know some people still own my own Palantir in the 30s, my own Palantir in the 40s, which then in the downside case, it's not looking good. But if assuming you're owning it in like the mid-teens range, then you're at least kind of projecting out a 2x return in this time frame, 2.5x return in this time frame. Which for me, if that's the bear scenario, the base scenario is 10x, and then I have a call option essentially if the business grows in excess of 30% per year to be 10, 20x, then I think it's a great risk reward profile. And when I see businesses like that have that kind of risk reward profile is when I just like go super heavy into an investment. Like for example, like Simon Property Group. Like my thesis there was the mall, like the retail apocalypse theory was way overblown. And instead, what was going to happen was the biggest players, which Simon Property Group, were going to consolidate the space. The lower class malls, the malls nobody goes to, were going to shut down, and only the best of the best would survive, and they would thrive because they're the only ones around. They're literally like the last domino to fall, but they're the only ones that are taking up the majority of the market. Which, even though the pie of brick and mortar retail is shrinking, their portion of that pie is expanding. Which my whole logic there was like, COVID is not gonna like be the death to brick and mortar retail. And so when China Property Group fell into like the 40s or the like low 40s, 50s, and then all of a sudden jumped to 160s, that made 100% sense. Plus, I thought it still had a lot more room to go. Like eventually, I'd exited the position because, am I gonna wait till like China Property Group hits the 200s, or am I gonna invest in like Tesla, put more money back into Tesla and wait for Tesla to try to 10x? I mean, that's an obvious risk reward profile. But at the time, like it made so much sense that there was going to be a massive correction in the near term for Simon Property Group, maybe more so than some of these other high tech names. Simon Property Group like 4x from a low, which in a year and a half, which I think is great. But yeah, so it's always about like just like what you expect the business to be able to earn in the future. What's your base case, and then compare it to your downside case. And in your downside case, you can still make money. And in the best case, like 10x, I think it's good.
Yeah. Yeah. I really like that. And what I've realized is you can't ever rely or shouldn't, in my opinion, rely on the bull case of a stock. I think if you're looking for a margin of safety, it really should be doing sort of your own analysis on the three scenarios, which could be bear, base, and bull, and then maybe just take like a weighted average between the bear and the base case, depending on how probable you think the scenarios are. And then the bull case can just be, as you said, like a free call option. Because I really think that's probably a fairly safe way of doing analysis, because the bull case, like as great as it is definitely less likely naturally. So I think that takes out some of the risk if you take out that increase in valuation from the bull case, and then check in, see how things go along. So I definitely resonate with that. And yeah, this has been very helpful. Thank you, Sebastian. I'm going to have to jump off. I really want to be respectful of your time. Thank you so much for joining. This was a really great discussion. Very excited to share it on my channel here. And yeah, I really appreciate your time. And thank you for breaking everything down.
Yeah, for sure, man. Yeah, it was a pleasure. Thanks for having me on.
Thanks, Sebastian. Take care.